Well, there's been a lot of talk lately about silver doing something impossible again, and about whether the bigger story isn't even the metal, it's the money system under it. So, in this video, we're going to separate fact from noise, and you're going to walk away feeling a lot calmer and a lot more confident about what actually matters. It's Sunday, February 15th, either what kind of silver you like, coins, bars, whatever, or what you think silver is going to do next. That's the whole thing. And I'm not mad at it. It's a YouTube tactic. It works. But here's the part people miss. A giveaway doesn't tell you anything about where silver is going. It tells you what the creator wants. Attention, reach, momentum, which is fine. Just don't confuse marketing with a market signal. Okay, now, the interview. This is where people start pulling quotes and turning them into doom trailers. The former congressman opens with a pretty grounded point. Precious metals aren't supposed to be a day trade. He's not sitting there trying to time every dip and rip. He's treating gold and silver like an insurance policy, something you hold because you don't trust the long-term behavior of governments and central banks. And that framing is actually important because if you're buying metals as protection, you're not emotionally dependent on the chart looking good tomorrow. You're dependent on something else, whether the reasons you bought still exist. So what reasons does he point to? Deficits, spending, borrowing, and the refinancing wall that comes when a mountain of debt has to be rolled over at higher rates. Now, you don't have to agree with every conclusion to admit the setup is real. Based on publicly available Treasury numbers, the US ended the last fiscal year with a deficit around 1.3 trillion, and net interest alone was roughly around $1 trillion. That's not conspiracy. That's bookkeeping. And here's why it matters. When your interest bill starts to look like a major government program, you're not just running a deficit, you're feeding the deficit with the deficit. It's like trying to bail water out of a boat while the hole is still open and the bucket keeps getting heavier. Now, the former congressman takes that reality and warns that eventually you can't keep papering it over. He argues that officials can manage rates and conditions for a while, but the longer you stretch it, the more violent the snapback can become. And that's the moment people jump to the scary comparisons like Weimar, like Venezuela, like currency destruction. So let's do the adult thing and define what we're talking about. Hyperinflation is not prices are annoying. Hyperinflation is a full loss of trust in the unit itself. It's when nobody wants to hold it because the next hour is worse than the last hour. And does the United States have risks? Yes. But is it automatic that the US ends in hyperinflation just because deficits are big? No. And this is where I'm going to push back just a little. The US is still backed by deep capital markets, a huge tax base, and an economy that can still attract global demand for dollars when the world gets nervous. That doesn't mean everything is fine. It means the path can look different than the most extreme historical examples. Even the guest in his own way hints at that by acknowledging the country's unique strength and wealth, basically saying, we're not the same case, but we're still playing with fire. That's a more nuanced position than the viral clips make it sound. And by the way, the inflation picture right now is also not matching a runaway narrative. The latest consumer inflation release shows year-over-year inflation in the low single digits with the monthly change modest. Again, not a victory lap, just reality. So why do people still feel squeezed? Because headline inflation cooling doesn't instantly fix the price level you're living with. A lot of costs went up fast over the past few years. And even if the rate of increase slows, the new higher level is still there. That's why someone can look at a report and say, inflation is easing, and someone else can look at a grocery receipt and say, no, it isn't. Both can be telling the truth. Now, in the interview, the guest argues that people keep looking for the wrong culprit. They blame businesses, they blame tariffs, they blame whatever the headline is this week. And his claim is the deeper driver is spending and currency debasement, especially when the political system keeps finding reasons to spend more, whether it's domestic programs, emergency packages, or foreign commitments. And we can add fresh context here. A lot of global institutions have been warning that advanced economies, including the US, are on an unsustainable fiscal track unless there's some kind of adjustment. Higher revenue, lower spending, or faster growth. That's not a political talking point. That's just math. So, what about tariffs? The interview takes a pretty hard stance. Tariffs won't solve the underlying problem. And I mostly agree with the spirit of that, but I want to sharpen it. Tariffs can shift incentives. They can reshape supply chains. They can even raise revenue at the margin. But if your core issue is that spending grows faster than your ability to pay for it, tariffs aren't the fix. They're a tool, and tools can be misused. In fact, even recent mainstream policy analysis has pointed out that tariffs often fall short of correcting deeper imbalances and can create their own distortions. So, if you're watching the tariff debate like it's the whole movie, you're probably missing the plot. Now, let's bring it back to silver itself, because this is where the silver price news part comes in. The host in that clip talks about silver whipping around, living in the double digits, then ripping into triple digits, then falling back hard. And yes, silver has been volatile. Recent market coverage shows that early this year saw a spike to record territory, and then a sharp pullback in a matter of days. Here's the key point though. Volatility doesn't tell you direction. Volatility tells you the market is stressed. And there's another layer here that people keep skipping because it isn't as dramatic as collapse. Silver is getting treated more and more like a strategic input, not just a shiny coin. In recent policy conversations, it's been grouped alongside other materials that matter for energy and tech supply chains. And that changes how investors behave when headlines hit. When a metal starts living in both worlds, finance and industry, you can get these weird tug-of-wars. Traders see a chart and want speed. Manufacturers see a component and want stability. And when both show up at once, the price doesn't glide, it lurches. Also, supply is not elastic. You can't just flip a switch and produce a flood of new ounces next week. Mining projects take years, permits take years, and the grades in a lot of mature districts have been trending the wrong way for a long time. That's why even with recycling, the market can run deficits for multiple years in a row. So the next time you see silver spike and everyone screams manipulation, pause. Sometimes it's not manipulation. Sometimes it's a thin market colliding with a thick narrative. And that's exactly why I care more about your plan than your prediction every single time. It tells you positioning is crowded, leverage is present, and expectations are unstable. So when the guest says, "Don't treat this like a trade," he's basically warning you about your own behavior. Because most people don't lose in metals because the thesis was wrong. They lose because they sized it wrong. They bought too much too late with too much emotion and then got shaken out when silver did what silver always does. It screams. It collapses. It makes you question your life choices and then it moves again. So the question you should be asking isn't, will silver go up tomorrow? The question is, why is silver so sensitive right now? And there are a few big reasons that have nothing to do with giveaways. 1. Silver is not just a money metal. It's a working metal. It's in solar panels, electronics, power infrastructure, and a whole bunch of stuff that quietly expands when the world electrifies. The latest industry survey on the silver market shows industrial demand hitting another record recently, and it describes a structural deficit that's persisted for multiple years. Now, I'm not going to throw a wall of numbers at you. Just conceptually, when usage keeps rising and supply doesn't keep pace, the market gets tight. Not tight every day, not tight in a straight line, but tight enough that when investment flows show up, price has to adjust. 2, the macro backdrop is still rate sensitive. The Federal Reserve recently held its policy rate in the mid 3% range. So when traders start thinking cuts are coming, metals often catch a bid. When traders start thinking cuts are not coming or not fast enough, metals can get hit. And because silver is the more emotional sibling compared to gold, it reacts harder. 3, we've had a huge global push into renewables, and solar is still the heavyweight. The International Energy Agency expects global renewable power capacity to keep expanding strongly through the decade, with solar doing a lot of the lifting. Again, you don't need to memorize a forecast. Just understand that demand for the ingredients of electrification doesn't disappear overnight. Now, here's the cliffhanger. If that's the real backdrop, why does silver still get slammed? Because markets don't move on backdrop. They move on positioning. Think of it like a theater. The story on screen can be great, but if everyone is already standing in the aisle, one little noise makes the whole crowd stumble. Silver gets those crowded aisle moments more than almost anything. Now, the interview goes further than markets. It turns into a warning about civil liberties. The guest basically says, when the money system gets stressed, people get desperate, and desperate people will trade freedom for promises. Some strong-armed leader shows up and says, I can fix it. And historically, that dynamic is real. Economic stress can absolutely lead to political overreach. But here's the nuance I want to add. The loss of liberty isn't always dramatic. Sometimes it's slow. It's small policies justified as temporary. It's surveillance justified as safety. It's new rules justified as fairness. And you don't notice the cage forming until you turn around and the door is closed. So the guest's warning isn't really about a specific person. It's about incentives. Now, the solution portion of the interview is where I think it gets interesting because it's not what people expect. Instead of saying, vote for this guy or wait for Washington, he basically says, don't expect the system to fix itself. He argues reform is painful, so politicians avoid it. And because they avoid it, the correction gets bigger. So he turns the solution inward. Education, civic awareness, moral framing of money. And I know that can sound soft, but if you zoom out, it's actually practical because the best time to build resilience is before you need it. So let me ask you something, and I want you to answer honestly in the comments. Are you stacking metals because you want to trade or because you want insurance? And second question, if silver drops hard again, would you buy more calmly or would you panic? Now, there's a sponsor segment in the middle of that original video that I want to address because it's part of the story ingredients. The host reads an ad for a service that claims you can earn a yield on gold, paid in gold, without selling your gold. They frame it like, instead of paying storage, you can get paid to own it. And look, conceptually, there are legitimate ways to lend metal or lease metal in certain markets. But here's where you need to stay sharp. Whenever someone promises yield on something that normally sits there as a store of value, you should immediately ask yield from what? And risk to who? Is it counterparty risk? Is it custody risk? Is it term risk? Is it some kind of credit wrapper? Because paid in gold sounds safe, but safety comes from structure, not marketing. So if you're considering anything like that, read every detail, understand the downside, and never confuse a promotional rate with a guarantee. Okay, back to the interview. The host tries to steer the guest into a debate about interest, basically asking if debt-free money could solve everything and whether interest itself is the problem. And the guest pushes back. He says interest is a price and prices matter. He argues that if you mess with that signal, you break the ability to measure value over time. Now, you can disagree with parts of that, but the underlying idea is solid. Markets need a measuring stick. If you ban the measuring stick, you don't eliminate reality. You just hide it. And we've already seen what happens when you hide prices. You get shortages, you get distortions, you get black markets. So, in a weird way, the interview is less about gold versus paper and more about honest signals versus manipulated signals. And that's the thread that ties everything together. Because whether you love silver, hate silver, or don't own a single ounce, you still live inside the signal system. Interest rates are signals. Inflation is a signal. Deficits are signals, and metals are in part a signal of trust. Now, let's connect this to what you can actually do instead of just nodding along. 1. If you're buying metals, decide your role. Are you an investor trying to preserve purchasing power over years, or are you a trader trying to harvest volatility? If you're an investor, stop watching the price every hour. You're turning insurance into stress. 2. Build a simple plan. If you buy, buy on a schedule. Small, consistent, boring. That's how you survive silver's mood swings. 3. Keep your expectations realistic. Silver can do incredible things, and then it can punish you for believing it. So position size matters more than prediction. And 4, if you're successful, share your success story in the comments so others can stay motivated. Now, before we wrap, I want to give you one more piece of fresh context that almost nobody talks about in these interviews. Even with fiscal stress, even with inflation cycles, even with political noise, the dollar doesn't just collapse in a vacuum. Reserve currencies weaken through a mix of policy choices, competitor alternatives, and confidence. And right now, one of the big under-the-surface stories is that central banks around the world have been buying a lot of gold over the past couple years as a diversification move. That doesn't mean the dollar is dead tomorrow, but it does mean institutions are hedging. And when institutions hedge, that's worth paying attention to. So here's the real takeaway from the whole viral clip. In my opinion, the giveaway is entertainment. The price talk is emotional. The warnings about deficits are real, and the path forward isn't to sit there hoping some politician fixes it. The path forward is to get educated, stay calm, and make your own system stronger than the one you're criticizing. So, if you want to enter the giveaway-style mindset without the gimmicks, do this instead. Like the video if it helped, subscribe if you want daily clarity, and comment one thing you're doing this month to improve your finances. Cutting a bill, paying off a card, adding to savings, stacking metals, whatever it is, because momentum is contagious. And one last time, tell me what day and date you're watching from, because I love seeing how far this message travels. All right, that's it for today. This is educational content meant to help you think more clearly about markets and money. It's not financial advice, and I'm not telling you what to buy or sell. Make your own decisions, do your own research, and if you need personalized guidance, talk to a qualified professional who knows your situation.